Welcome to the daily update where I'll go over the action in the market for Thursday, September 26th, and then we'll see how things look for Friday, September 27th. Had a really solid open, but we gave a lot of those gains back, but we still ended positive. We finally are seeing a little bit of selling into strength. We're still looking good in the short, intermediate, and long term. As always, there are some warning signs that we need to be aware of that I'll go through in the charts as we get to that part of the video. But at least for the time being, things are still looking pretty solid. Now we have core PCE coming out in Friday's session. Will that feed into this idea that the market can still go up because inflation is more friendly? Or is it going to spook the markets and cause some people to rethink the current scenario that we're going to have a soft landing? There's a thing called the SPXInvesting Program. It's a program that I have developed and it's launched. It's up and going. There's a website that you can go to. There's a link to that in the description below this video. There's also a link to a video that you can learn more about the program. You can also email me with any questions that you might have. It's still free for the time being. I'll be locking that down at some point, but you do get access to the videos as soon as they're available, where I wait to make those public on YouTube and Rumble. Also, the daily video is where I really do my analysis. All of the other weekly videos that I'll be preparing over the weekend, those are meant to feed into the daily video. All right, let's go back and talk about what happened and then look at some charts. We had a gap higher open. The futures were quite strong, but we immediately saw some selling into strength, right? As that was happening, we set the high right at the open. So we got above R2 at 57.54, which was not all that hard to do because the last couple of sessions, the high-low range was not very wide, and the R levels and S levels, they're set by the previous day. So if we have a narrow range, that's going to make R1, R2, S1, S2 be a lot closer to each other. But we got above R2 at 57.54. That was setting the high. Then we declined back below R2. We got down below R1 at 57.38. Then we rose back above R1. It looked like, okay, maybe enough of the gap was filled to try to take things higher, but that didn't last very long. We declined back below the daily pivot at 57.25, but we found support at the unchanged level. And even though I talk about daily pivots and R levels, S levels, the unchanged level is a built-in support level when we're having an up day and a resistance level when we're having a down day. And that's where we found some support, and we were able to rise back and close above R1. We were up 0.4%. Now, we were up almost double that with the futures. So we gave a lot of those gains back. We were actually above average with volume, and we are positive in the short, intermediate, and long term. We'll get another read on interest rates in Friday's session, and as well as inflation feeding into those interest rates. And we want to keep an eye on the geopolitical things, specifically right now, what's happening in Israel, if there's going to be more of an escalation in the Middle East. But oil is continuing to drop. It's now under 70, so we're not really seeing a rise in that area. Some comments. We did set another new all-time high with the S&P 500, and the semis ended up being strong. That's a growth area. That's a huge part of tech. So seeing them do well, specifically Micron, and that was when I first started in the market, that was like one of the big companies, Micron and Intel. They're still big, they're still influential, but things have shifted since that time. And the Swiss National Bank, as well as Mexico's central bank, did cut rates. So not only are they cutting rates in the US, but we're seeing other central banks coming out and cutting rates as well. We do have a confirmed Hindenburg omen that was generated on the 12th of September. We're also in what's supposed to be a period of weak seasonality, but neither the omen or the seasonality has really come to fruition, at least yet. On a short-term basis, our Stochk RSI, Williams percent R, the CCI 14 is still not on the list, but the CCI 20 is. The slope oscillator, our stochastics, the RSI is back on the list, and we also have the boom indicator based on 20 periods. That's how far away we are from the 20-period moving average. That's back on the list after dropping off. Intermediate term, back on the list is the 50-period exponential moving average just on the S&P. CMB composite. It's coming down, but it's still extreme. The PMO studies, the Sean trend meter, the bullish percent index for the S&P. This continues to go up, and we're getting really a high reading with that chart. And sometimes that means that we're seeing some kind of a top there. The money flow, that's a new addition to the list. The 10-period moving average of the new highs, new lows for the S&P. That's more intermediate to even somewhat long term. And then another new addition is the 100-period moving average study. Those are stocks inside of the S&P that are above their 100-day moving average. That's starting to look a little extreme. On a long-term basis, we're looking at the 150 and 200, the simple moving averages, and then the exponential moving average just on the S&P itself. We haven't changed the scenario. We'll see if that does end up changing in Friday's session with the core PCE coming out, where the Fed did come in last week. They cut rates 0.5% because the soft landing scenario seems to be likely at this point. The dollar was down and interest rates were up. We climbed from 3.78 up to 3.79. So not a real big change there. We're still inverted with the 10 to the 3-month yield curve, where the 10 to the 2 has gone back to remaining uninverted for the time being. And sentiment. Now, we're getting kind of close to that 75 level. That is extreme positive. We're just 3 away from that. We came in at 72, where we had been at 67. With some of these extreme positive readings that we're starting to see in the short and intermediate term, if we get really excessive sentiment at 75 or above, we can go above that and we can stay there for a while. But when you see all of these things converging together, we just want to be more aware of that. We are positive with our trend. We have an ADX that is above 20. It's above its moving average. The green line's on top. So this is now a confirmed intermediate term positive trend. With the up day, the bias is positive, and then the last number of days together, that's our momentum. That continues to be positive. We did get initial jobless claims. This is showing that the employment situation is holding up for right now. Came in at 218,000. They thought it would be 224,000. So fewer people filed than they thought. Last week, we saw 222,000. The continuing claims actually went up, and I have charts to show you of this, at 1.838 million. Last time it was at 1.821 million. Durable goods came out unchanged, which was actually better than expected on a month-over-month basis. They expected it to be down 2.9%. Last month, it was up 9.9%. When you take out transportation, it was up 0.5% month-over-month. That's more than the 0.1% they thought it would go up, and last time it was up 0.1%. Then we did get the third reading now of second quarter GDP. No changes there, so that didn't really have an impact on the market. Last time it was at 3%. They expected 3%, and that's what came out, was 3%. The deflator, which is the inflation component of this, came in up 2.5%. Again, what we saw last time and what they had also expected. Pending home sales, I won't show the chart of that, were up 0.6%. They expected them to be up 1%. Last time they were down 5.5%. Okay, so here are the weekly jobless claims. And this is looking pretty good. We're going down with the raw number. That's the black line. And the 4-week moving average is also going down. Doesn't necessarily show that we're going into a recession based on this. Now, we know these numbers are manipulated and all that stuff goes on, but this is what the market follows. And they're using that to justify that, okay, the employment situation is holding up for right now. It'll be next week when we get the employment situation report, next week on Friday. Continuing claims did go up, but we're still below a declining moving average here overall. Putting them all together, the latest reading on unemployment, which will be updated next week, we saw continuing claims going up, but initial claims going down. Durable goods on a year-over-year basis, slightly negative right now, not necessarily falling apart, but not showing a lot of strength on a year-over-year basis. When you take out aircraft, we're actually below zero and showing a decline there. Month over month, we were positive, but well off of the reading that we saw last time. And then the GDP, real GDP, which takes inflation into account, and the deflator, The blue line, that's GDP, where it's going up. So, I mean, it's not gangbuster growth for the economy, but 3%, it's showing that there is growth. And then the deflator is actually declining. And if anything, the market likes that when they look at it the quarter over quarter basis here. Personal consumption year over year going up just a little bit, looking positive there. People are consuming things. And the net exports still having a tendency to be negative overall, but a little less negative in the latest reading. Real GDP on a year over year basis still looking positive across the board. That's the takeaway from this that we use anyway. Then looking at some Isabel Net blog charts here, the percent of 10-year yield curves that are inverted, it is coming down a little bit here, but we're still getting quite a high reading. Whenever we get above this red dashed line, that means that they're really looking like we could go into a recession. So this chart, even though it's showing some improvement, folks could look at this chart and say, yeah, we're going into a recession. But there's a lot of other charts that we could look at that say, no, we're not. A lot of new highs, okay? From 1957 up to now, we've seen 22.3% of the days where we've made a new all-time high with the S&P. And it's not really strong like it's been in the past, but it's still a very respectable reading. Here's a look at some cup and handle. I'm not a big believer in that, but I know a lot of you that watch these videos are. This is showing the possibility of a breakout. And you can say, yeah, okay, here's the cup, here's the handle. And then we see a real up move after that. What the takeaway that I'm getting from this is that we're seeing, even though there was a negative divergence here with the cumulative up volume, we're seeing that really going up, even though it came down with this chart a little bit, that's breaking out as well. And that's when I say we want to see volume at least matching price. Sometimes when volume leads price, that can be even more positive to help price even go higher. Then looking at the risk love relationship, I guess the RS or RL indicator here, not really getting extreme. This is more of a global basis here. We're still more in the neutral area. And then the cumulative flows going into stocks over the last 2 years, a lot of money going into stocks. And that, at least to this point, was the right thing to do. And then recessions have quickly followed with short-term interest rates are this bearish. This is a little bit of a concern. We're seeing short-term rates really going down. And this is the 6-month Fed funds minus the Fed funds rate. This is a pretty low reading. And if you know much about what has already happened, when we get really low readings like that, a lot of times not long after that is when we can have a tendency to go into a recession. This is another chart that would point to yes, recession. But again, like I say, we have charts that say no recession. Then Fed policy rate, our forecasts against the rising price and the dot plot here. This is pretty much leveling out here, but we're looking more right now. This is when they cut rates and they see this stair stepping down for about another year or so, maybe into early 2026, if that's how things end up playing out. This is not taking into account some catastrophic event or a black swan event or something that hasn't been foreseen yet, that the market hasn't been able to put into its current thinking. If things play out the way they are right now, this is what they project that will be going forward. Looking at the buybacks, this tends to be positive for stocks, seeing the year over year average going up. And then we have the S&P 500 buybacks year over year also going back up here. And the economic surprise index, it is coming up, where this is actually kind of positive for right now, where good news is good news. We saw lower than expected initial jobless claims. We're seeing fairly healthy or better than expected economic reports, at least right now. That means this line is going up. Now, if we cross above zero and we start to get too strong, that's going to throw this whole the Fed's going to cut rates scenario into question. So even though it's coming back up here, we want to maintain that balance where good news is good news and bad news is bad news, because we spent a lot of the last couple of years of good news being bad news and bad news being good news. And then the big drop in the U.S. jobs plentiful index, I wonder who came up with that name. This is where we're just seeing new jobs. According to this chart, we're not seeing as many as we were before. Okay, didn't spend any time on Twitter because I'm still traveling these days. So we had a really nice gap up and we came back down. It looked like we were trying to bounce back up. We got above R2. We came down and fell below R1. Then we tried to bounce. That really didn't happen. We came all the way down below the daily pivot, hit the unchanged level. This was the support level. And then we were able to bounce back above R1 and then go sideways into the close. And really, we're unchanged right now with the initial overnight session when looking at the futures. This is still a bit of a concern. We're going up with the red line and the blue line, but we want the blue line to be above on the intraday chart. And not much of an improvement here with S&P growth of value on an intraday basis. We want to see this really going up. It started out up. You can see how high it was right at the open, and then it really fell off after that. Our end of day charts where growth was up, but up about half as much as value. Growth was up less for the mid caps and also up about half as much for the small caps. But we saw a little bit of an improvement here. Not much to really change things with small cap growth to value. Mid cap growth to value, also a little bit of a tick up, but we need to see a lot more from that. We actually declined here with S&P growth to value. We were a little bit encouraged seeing this going up and the fact that it dropped back, especially as the day went on. People were still selling a lot of the growth stocks, and that's what was driving things down. We want this ratio to continue to go up. And we came down a little bit when we look at the growth versus value ETFs here. We're still in the middle of the rainbow. This is also encouraging, though. The discretionary to staples still looking better. We are seeing some follow through here, so that is a good thing. We're still looking good with our large cap growth, but didn't set an all-time high. And we are now above 20 with the ADX. We're above the moving average. So we're in a confirmed trend. And the green line's on top and going up, so that's a positive trend. We're seeing pretty much that same thing here with the short-term chart. Above the moving average and the green line on top and going up as the red line's going down. And we came up with volume, but this measures volume over the last number of days, so that's why you see this still tending to decline, because we've been below average with volume until Thursday's session. Sentiment, we declined just a little bit with the VIX, both on the line chart as well as the bar chart. We're also declining with the VIX of the VIX with the bar chart and the line chart. The momentum of the VIX continues to be down, but we're looking at this historical seasonal chart here, what the VIX usually does, but it hasn't really started doing that yet. And we're still looking at an elevated level for the SKU index. This is a variation of the VIX, and this is just that the market is expecting some kind of a big move. Whether that's going to be to the upside, that you could make a case for that, or if it's going to be to the downside, maybe it'll be in Friday's session with core PCE, either surprising the market in a positive way and we go up, or in coming in stronger than expected and freaking out the market and sending us down. We don't know that yet, but this indicator is anticipating, and has been now for about a week, that some kind of a big move is expected. It just hasn't really developed enough yet to bring this indicator back down. We did get the latest reading from the American Association of Individual Investors. They're still quite positive, but not extreme positive currently. We ticked down with this fear gauge, and we also ticked down with the other fear gauge. So we're seeing some confirmation there. We're still going up with the risk on versus risk off ratio. When this goes up, folks are preferring to be more risk on. That's positive for stocks. And why here is the SKU index again. Just in case you didn't see it before, here it is another time. Okay, a little bit of a mix up here with the charts. Okay, I'm in vacation mode, so please forgive me. We did decline here with the equity put call ratio, but now we're starting to get extreme here with the 5-day chart. We're dropping below this level. And if you see other times that I have marked here, now we haven't necessarily hit the bottom and started to go up yet. We could still go lower than this, but you can see what that meant for the market. Sometimes it just meant we slowed down. Sometimes we were still able to keep going up after that. Other times it would come close to actually marking a top in the market. And we're also getting extreme here with the 5-day chart. We're still declining with the 10-day chart as well. And the volatility risk premium is still below the band, showing that there's not a lot of fear as measured by this particular indicator. We are looking okay, but not breaking out to new all-time highs with the advanced decline line based on price. We set an all-time high with the S&P, but not with price. We're actually looking a little better and setting a new high based on volume. So that is positive. But with the new high that we set, we didn't see a real expansion of the new highs here on this chart. It's still healthy, and we're still going up with the 5-day, even though it's rolling over a bit. We're starting to flatten out a little bit with the 10-day. And it's not that the new highs are contracting. Well, it's not that the new lows are expanding. It's that the new highs are contracting in this overall reading. We ticked up a little bit, and we're still above zero with the advanced decline ratio. We're positive with the advanced decline ratio based on price and volume. We're still looking positive, even though we declined a little bit with accumulation distribution. We could still potentially be kind of far away from that moving average, which would suggest an extreme positive reading. The money flow, we set an all-time high, and we're flat with this. A little bit of a concern. You just want to keep an eye on it. We were watching this, and then it fixed itself. So now we'll watch it again to see if it's going to fix itself or show more weakness. And we're declining here with the Chaikin oscillator. A little bit of a concern there. But the vortex actually really breaking out with the blue line. But be aware, the red line is now starting to get down to an extreme negative reading. Looking okay here when we compare the S&P to the NYSE advanced decline line. And with the cumulative advanced decline line for the S&P, didn't really break out, even though we're setting an all-time high here. But this is positive. We are breaking out and setting a high based on volume. Saw a positive score with the new highs minus the new lows, and the 50-day is continuing to go up. Here's a further breakout of the 50-day moving average study. This is longer term, the 10-day average of the highs minus the lows, getting a very high reading here. That's intermediate to somewhat even long-term positive. And with the NYSE cumulative advanced decline line based on price, we are breaking out here, but didn't see much of a big change here with the NYSE advanced decline line, but still looking positive overall, even when we look at this other NYSE advanced decline line. And when we break it out based on common stock, we're not necessarily setting a new high here, but we're actually looking a little better based on volume. The new highs minus the new lows still getting a positive reading there. So our 50-day moving average on the NYSE is positive. The 5-period moving average of the highs minus the lows came down, but is still quite positive. And we came down just a little bit when we look at the ratio between large caps and small caps, but it's not really moving in one direction or the other right now. It's just chopping around. The advanced decline line studies are looking positive for the NYSE, the S&P. We went up with the mid caps and started to turn back up here with the small caps. We came back up with those stocks above their 20-day moving average in the S&P, and we're above 50. That's positive. We went up with the 50-day moving average study, but we're starting to get just a little bit extreme with the 100. And this is, again, more long-term intermediate or short-term long-term, if that makes sense. I usually go with the 20 short-term, 50 intermediate term, and then 200 long-term. This is kind of right in between those. We did go back up, and we're not extreme with those stocks above their 200-day moving average. Short-term, not really much to see here. We're kind of in no man's land as far as what's plotted on this chart, and we were above average with volume down below. We're going back up with the 20, starting to get extreme with the 50 and 200 period exponential moving averages. So we're extreme positive with the Stark RSI. These are our short-term indicators. The Williams percent are. The CCI 14 is still not quite extreme positive, but the CCI 20, even though it declined, is still above 100. Looking positive here with the force index. The stochastics in the short term, even though they're rolling over, they can't really go much higher than they've already gone, so they kind of have to come down. Rolling over a little bit in the intermediate term, but still extreme, still going up and above the moving average in the long term. The condition of the short-term moving average, 20 periods, still above both lines. That's looking positive. Still above both the 20-period simple and exponential moving averages. We're extreme when we measure the distance away from the 20-period moving average. We're getting kind of close here. Actually, we're just under 200 right here when we measure the distance from the 50-period moving average. And we actually came down a little bit. We're coming back into the +2 channel. We were starting to go up into the +3 channel. So this is not extreme right now with our standard deviations chart. Balance of power above zero and advancing, that's positive. The CMB composite is right on the black line, so it's still extreme. The condition of the 50-period moving average, we're above both lines, and both lines are going up. The go, no go is still positive with the dark blue bars. And we are still dealing with the blue line here, which is the highest high value, and the midpoint continues to advance. That's positive. The TTM squeeze, after coming to life, is still looking positive. If we get up to this black line, that would be extreme positive. We're above zero and going up with the ease of movement. The Arun indicator is still positive. We're still negative here with the S&P McClellan oscillator. We tick back up, but we're still below zero. So what we're seeing here is a little bit of a rolling over here with the summation index based on price, but we're still going up based on volume. That could be positive, but we'll have to see how this plays out because sometimes volume does lead price. After going slightly negative, the NYSE McClellan oscillator has now crossed back above zero. So we're still going up again now with the summation index for the NYSE based on price and volume. But here's another concern. The Swenlin trading oscillator still continues to decline based on price. We're going up to flat here based on volume, but both are still above zero. Momentum is still positive with the PMO. We're actually rolling over based on price where we're looking more positive based on volume. That could be positive for the S&P. So we ticked up a little bit here with the PMOs that are rising. We're flattening out after declining with the buy signals, and we're extreme positive with the PMOs that are above zero. We've remained at neutral with the Elder's Impulse system for the S&P. We're positive with the parabolic SAR. We're looking possibly extreme here with the slope oscillator, the green line, but I put this on here as just a guideline. We're still looking positive with the MACD. So all of our oscillators, you could make a case for, okay, we set a new all-time high, but it's a lower high with the slope oscillator. That could be considered a negative divergence. And we are breaking out a little bit here with the TSI. So that kind of looks a little more positive. The MACD is still going up. And you could possibly make a case for this high. And so far, we're making a lower high with the MACD, the PMO, and the PPO. Even though the trend of these oscillators continue to be positive, we're also making a lower high here with the TRIX and KST, but we're still positive for right now. The copy curve continues to be positive. You could also make another case. Setting a high here, we so far have not set another high with the copy curve. The Sean trend meter is flat, but still extreme positive. We're above all of the moving averages here, so that's positive for a trend. And here's the BPI. It just continues to go up. We're at 79.8 now. That's a pretty extreme reading. We're still going up with the NYSE bullish percent index. We turned back up with the NASDAQ 100 bullish percent index and positive there. We're getting extreme with the money flow, and we're turning back up with the ultimate oscillator, so that's positive. We're above an advancing moving average with the on-balance volume. We're not extreme with the RSI 14, but we're starting to become more extreme with the RSI 9. The 9 is the short term, where 14 I use more in the intermediate term. This is showing an improvement too with the Ichimoku cloud. The blue line is now going further above the red line, and the green line is also going up. So we're still looking good here on the weekly chart. We're well above the R2 pivot point. On a trending basis, the Heiken Ashi is still positive. The Kegi is positive. The Renko chart is positive, and the three-line break is positive. And we had a new X drawn into the point and figure chart. This is now a double top breakout. It's really strange because we have a very similar reading to this on the weekly chart, and it's saying it's a triple top breakout. So, okay, double, triple. Let's go to In-N-Out Burger and get a couple of double doubles. All right, now we are looking kind of extreme here with the 150 and 200, but that could also suggest good long-term momentum. But we've been seeing that for pretty much all of the month of September. We are positive across the board on all time frames and indexes with the Keller market model. We're negative with bonds in the short term, positive in the intermediate and long term. We're still positive with commodities in the short term, but negative in the intermediate and long term. The dollar is still negative across the board. The three sectors that ended up being down were utilities, real estate, and energy. Now, you could, again, utilities is kind of hard to play right now because of the whole AI, Bitcoin, and crypto mining. Real estate tends to be more defensive. Energy's been getting hit lately. It got hit almost 2%. It was by far the weakest. So we're just keeping an eye on things like staples. We want discretionary to do well. We want communication and tech also to do well. Those are growth areas. And everything was positive up until near the close here, where the Dow dropped below 42,000, but it went above at first. We set a new all-time high with the S&P, but we left that in the dust early in the morning. Discretionary setting a 2-year high. We like that. We like the NASDAQ going above 18.1 and 18.2. Canada, they seem to be having a lot of fun there. Oh, Canada. Materials, which is more of an economic area. If the economy's doing good, materials does better. We're seeing a BPI above 70, but the euro is making a 52-week high against the dollar. So if you're traveling to Europe now, you're not getting as good of an exchange rate. And the Dow also set an intraday high, but not a closing high. Still looking okay here. Not much of a change when we look at the equal weight versus the S&P 500 weighted index. We went down a little bit here with this ratio, but we've been kind of chopping around lately. The Dow did set a new intraday high. This is not an intraday high here. Okay. Anyway, but still looking good for the Dow. We are neutral with the Elders Impulse system for the diamonds. And we came well off the highs, but the bar actually looks a little bit better here with the NASDAQ. But closing off of those highs is a bit of a concern. The NASDAQ 100 also closed off of the highs, but we're starting to see a little bit of an improvement when we take all of these bars in context. We are positive with the Elders Impulse system for the Qs. The momentum for the NASDAQ 100 is positive. We were up 0.75% with the small caps, but we bust up and then break down. We're still positive overall, though, with the small caps, but they remain neutral with the Elders Impulse system for the small caps. We're still above 50 when we look at the Russell 2000 small caps. With the RSI, we're above the 50-day moving average, rolling over, but still positive with the momentum. And here's the mid caps, just kind of chopping sideways right now. They continue to be neutral with the Elders Impulse system with the mid caps. We did set a new all-time high with the Wilshire. That's a broad market measure. We also set an all-time high with our total U.S. stock ETF. So that's positive. We're continuing to go down here, but we still have an uptrend when we look at the staples to tech ratio. We want this to go down. The trend is up, but lately we've been coming back. If this can continue to fall and actually see this roll over and do a death cross with this ratio, that would actually be more positive for tech. Financial sector was up 0.5%, but not setting an all-time high, but still above its 50-day moving average. The FANG index was down just a little bit and has been chopping sideways lately. And we're still below the shorter-term trend line. We're still above the longer-term trend line for the FANG index. Amazon was down 0.71%. And let's see, Apple was up 0.5% above its 50-day moving average. We were down a little bit with Microsoft. We're not really liking what we see here with the 50 still coming down to the 200. That could potentially lead to a death cross. Google was up 0.75%, coming back down, or excuse me, coming back up to a declining 50-day moving average. Meta was down slightly, but still probably one of the better looking charts we have right now. NVIDIA was up almost 0.5% above its 50-day moving average. Tesla was down 1%. It's had a pretty good run lately, but it's still in an uptrend and above its 50-day moving average. Netflix down 1.4%, still well above its 50-day moving average there. Seeing a little bit of a weakening between U.S. and world stocks in the short term, but still maintaining that longer-term correlation. And we dropped below 70 with oil. The dollar continues to be in a downtrend, even though it was up. And we were just not really changed all that much. We were up just a little bit here with the 10-year yield, down a little bit with the 10-year based on price. Seeing a little bit of improvement with Qs to S&P. We want this to go up. Discretionary, it flattened out, but it's been one of the better looking areas lately after spending most of 2024 really being a disappointment. And we came back down, but we're still above the moving average when we look at large cap growth versus large cap value. So with the large caps, we're looking okay. We're above the moving average with the the mid caps and the small caps. Almost said mall caps there. We're still going down here with the S&P to utilities ratio overall. We ticked up a little bit here, but we want this really to go up to be more positive for the S&P. And we want this to go down when we look at staples to S&P, and it has been going down lately, and that's giving some support to the S&P. And then here's just an updated chart of the Hindenburg-Ullman. No changes here, no new spikes. We'll have to see if something else is created. It's already been confirmed. If we see additional spikes here, that would just be more of a confirmation. So what's our outlook for Friday? We are still positive, but we have this Hindenburg-Ullman that could develop into something at some point, but it could take some time to work out. It's already been taking some time. And we have weak seasonality, which to this point doesn't really seem to matter, but that could change at any time. We're still finishing out the week after options expiration, which tends to be down a lot more than up. We're going to get the advanced international trade in goods, retail, and wholesale inventories. I probably won't show charts of that. This is the big one, personal income and spending and PCE prices and core PCE. That's a pretty big one. And then the geopolitical things going on in case they have an impact on the market. Here is Friday's completion of the economic calendar. Here's also a look at what was expected at the time I took the screenshot of this calendar. Seasonally, we're neutral to positive with the Dow and S&P, where we're flat out negative with the NASDAQ. One thing to be aware of, we're finishing out the week after options expiration where we've only been up 30% of the time going back to 1980. We do see some weak seasonality coming into the 27th before we see a nice little bounce going into Monday's session, which will be on the 30th. Friday is the second most positive day of the week. It's positive, and I guess still the second most positive day of the week so far, what's been happening in 2024. But this is the negative seasonality that we typically do see. Also comparing 2024 to 2023 with the negative seasonality. So the warning signs, we do have this Hindenburg-Ullman. We've got weak seasonality. I feel like a broken record, but it just really hasn't started to develop. And it may not, but it could develop. And we just want to be aware of this. We're keeping an eye on the different defensive sectors, staples, utilities, and healthcare. We're watching energy because, again, utilities and energy that, could end up being your growth area with all this green stuff going on. The S&P McClellan oscillator and summation index, it's still negative because we're below zero there. Growth to value showing some improvement, and we're still seeing some improvement as well with discretionary to staples, but it's still a concern until we see some real follow through on intraday charts and end of day charts. Positive signs showing some weakness here in our smart money indicators, but still looking positive with accumulation distribution. The Chaikin money flow is flat. The Chaikin oscillator is declining, but still positive. And the 5-period equity put call ratio is extreme now. We're getting to a very low reading. The 10-period is continuing to go down. The advanced decline line is still looking pretty solid there. The NYSE McClellan oscillator and summation index, that's looking positive after switching back over to negative. Then it became positive again. Our oscillators show that momentum is positive. We're a little bit concerned about these weird readings that we're seeing with the Swenlin trading oscillator. But the parabolic SAR is positive. We're extreme with the bullish percent index for the S&P, and we keep ticking higher. We're positive with the NASDAQ 100 and NYSE bullish percent indexes. The vortex is positive, but the red line is starting to get extreme negative. The money flow is looking extreme positive. The ease of movement is positive. The ultimate oscillator, the momentum for the NASDAQ 100 is positive, and the financial sector is still positive. So our conclusion, haven't changed this. We're still positive, but we have these potentially negative things in the background, the Hindenburg-Ullman and potential weak seasonality. On a short-term basis, we are looking extreme positive. You could also say that's showing good momentum. Intermediate term, we're positive, but this is where we might see these more negative things in the background that could, if they come to fruition, that's where it would have the most impact. Long term, we still continue to be positive, even though we're extreme with the 150 and 200-day moving average. Thank you. I hope you found this helpful. Have a great day on Friday, and I will talk to you in the next video.